Welcome to the Ignite podcast. Today we're joined by Martin Tobias, which we're delighted to have him. He's one of my mentors in this whole venture capital crazy game that we play. And Martin, thank you so much for joining us. Would love to get an intro from you for the audience.
Hi, Brian. Thanks for having me. Yeah, I'm a long-term angel investor. I was early at Microsoft before the IPO. So what I always tell people who want to be investors, first you make a giant pile of money somewhere, and then you go writing checks. It's pretty easy. So I made a little bit of money at Microsoft, started investing in venture funds first to sort of learn the craft a little bit, and then did some angel investing. And I started along the way, I went back and forth from being a operator to investor. I was 3 times a venture funded CEO. I raised over $500 million. I'm an LP in 17 funds, invested in 250 companies directly as an angel. And about 3 or 4 years ago, when the pandemic started, I was running a company in LA, and it got shut down by the pandemic. And I was like, I don't know what kind of company I would want to run in the middle of a pandemic. So maybe I'll try doing investing again. I think, like you, I started writing checks, and then some friends said, we want to invest with you. So I started a syndicate on AngelList and have about 3,000 LPs there. And then a lot of those LPs said, we want you to start a fund. Could you please just let us invest in everything you invest in? So I started a small fund on AngelList, and then I moved on to a larger fund. And I'm pretty much going to be doing investing now instead of CEO stuff for the rest of my career. I think it's a little more better work-life balance for what I want now. And also I think can be pretty impactful having been an operator, 3 times as CEO with 2 IPOs. I find it very helpful to the CEOs that I work with.
Yeah, great introduction. And you find time to counsel and mentor would-be syndicate leads like myself when I'm just getting started. I remember distinctly where I was a few years ago. I was at my son's baseball game. You're like, hey, let's jump on a call.
Okay.
I'm like, okay. And, I'm just walking around the field talking to you on my, AirPods or whatever. And you're just counseling me on like what it's like to run a syndicate and, how to get started. And it was right at the very, very beginning of Team Ignite. So much appreciated, and wanted to thank you publicly for that.
Sure, anytime. I like doing that. The more the merrier.
Yeah.
And there are some gotchas in this business for new investors. So I want to help us all out by avoiding those. I'm doing a presentation next week in San Francisco at a conference, and it's how to switch from being an angel to a professional VC.
Is that the Decile Summit?
At the Decile Summit, yeah.
Oh, nice. Oh,
and it's definitely a mind shift when you're managing other people's money.
so a little plug for the Decile Summit. We'll be there next week in Silicon Valley. If you want to come see Martin talk, I'll probably get this podcast out in the next day or two, so the people will hear it before then. Man, I don't even know where to jump in. You've done so much in your career. Walk me through that transition period from made a little money, post IPO at Microsoft, and what you did next.
Well, at the time, I was working in a group called Electronic Software Distribution. It was kind of the beginnings of Microsoft's attempt to digitally license their software for the enterprise. And they were being asked by the enterprise at the time. They were shipping, if somebody bought 10,000 copies of Windows, they'd get 10,000 boxes with CD-ROMs, and they'd have to keep these, holograph printed codes along with their things. It was a giant logistics nightmare. And companies were saying, hey, we just want to download the software to our computers and manage the licenses electronically and not handle all these boxes and have to track these physical things. Can't you design maybe some software to license, software?
Oh, wow. Reminds me of the McKinsey video on Last Week Tonight. John Oliver, I don't know if you caught that one.
Yeah,
it's hilarious.
That was funny. And so I was in the group that was trying to do that. And in order to do that, of course, there were lots of company startups, in this area of digital rights management, electronic software distribution, digital wholesalers. So I was working with all these startups, and I was, working at Microsoft, but I was thinking, God, these startups guys are kind of having more fun than me. And some of them were raising money, and I was like, oh, maybe I could invest. And so I invested in one or two of them, and then I gave them a deal with Microsoft, which immediately got me a markup on my investment. And I was like, is this legal? Like, for me to do this? Like, it seems like it should be illegal, but that's exactly how, investing works. Like, you invest in a company, you add value to it, and hopefully get its business development prospects, improved, and revenue and stuff like that. And then everybody makes more money. So I started investing when I was at Microsoft, and then my first actually.
What year was this, just for context? What year was that, just for context?
That would have been 89 or 90.
Wow, that early. Wow.
Yeah.
You don't look that old.
Thank you. It was quite a while ago. And
I was like in grade school.
Yeah, exactly. Right. And then I, 90, no, it might have been 92, 93. And then I met this guy in Silicon Valley named Ron Conway.
Oh, wow.
Who started Silicon Valley Angels. And he's like, there's this thing called a venture capital fund. You could be an LP, and I'll go do all the work for you, and you get all the money. And I was like, oh, that sounds good. So I gave him some money, and it turns out, he was walking around with a shotgun in Silicon Valley in the late 80s, early 90s. And he gave $500,000 to these two guys named Larry and Sergey. And
best seed investment of all time.
Right. And gave LPs.
He was actually in the seed round, the $5 million round, or was it the $25 or $30 million
I'm
round?
not sure exactly which round
but
he was
super
in.
early.
It was super early, one of the first, if not the first. But basically, he gave LPs in the fund IPO shares when Google went public, some of which I sold, some of which I still own. My cost basis is like 50 cents on Google.
Yes.
And I've never sold those shares because it's a lifetime lesson of the value of getting in early to potentially transformative companies and holding transformative technology companies for the long term. It can be truly transformational money. But
I tell this story to folks, right? Like, if I'm talking to like an LP in my syndicate or whatever, I tell that story of Google because it's one of the greatest early stage investments of all time. I mean, if you're in the $5 million seed round, currently your markup would be 400,000x.
400,000x, yeah, it's insane.
It's insane. You put 25K, and you'd have $10 billion now.
Exactly.
Not counting dilution and all that stuff, but you'd have single digit billions of dollars.
Yeah, billions and billions of dollars. Yeah,
for a 25K investment.
It's absolutely insane. And I mean, there were a couple other formative things that reminded me of the power of being in early transformative companies. I bought Amazon. This was after it was public, but I bought it at $6 in 2000.
Well, and back then companies were going public much earlier. I think Amazon, when they went public, their valuation cap was like 200 million or 400 million.
Yeah, exactly. Yeah. But I mean, actually, in 2000, everyone thought they were going to go bankrupt. They had, they'd been losing money. Walmart had better numbers. Anyway, then they did $1 billion debt deal, which saved the company and turned it around. But anyway, so I've been doing this for a long time. And one of the reasons I'm running a fund now is that, I wanted to give those experiences to new limited partners and to help out new CEOs. It's going to be rare that you or I are going to invest in a company as great as, a Microsoft or an Amazon or a Google. But they're still happening. They will still be created. And, 20 years from now, we'll be talking about, companies other than FANG, possibly. And hopefully you and I will have been investors in some of them, and some of our LPs might as well.
Let me ask you a philosophy. And we were kind of getting into this, in the preamble before we started recording, but as an investor, if you go make 100 investments, let's say, in a fund or two, would you be happier if one investment went, let's say 1,000x, which would mean your portfolio ended up being a 10x, which would put you in the top, 5% or 2% of funds, something like that? Or would you be happier as an investor if you had all 100 go 10x?
Well, it really doesn't matter what I want or what would make me happy or not, because the reality is that the power law is real and the power law defines all of your returns in venture. I hear some venture funds and accelerators going around trying to preach the, we fund singles and doubles things. That is a losing strategy, in my opinion. I've been doing this for 25 years. Singles and doubles do not make the returns of the funds. You cannot. I mean, the theory is that you can more easily and replicatably and reliably invest in companies that are singles and doubles than you can finding unicorns. I believe that. The problem is there's just not enough money in singles and doubles. People
at some point you have to concentrate depending on your fund size.
Yeah.
If you start having to deploy $100 million, $250 million funds, you have to concentrate at that point because you just cannot spread that money out far enough to get all those singles and doubles.
And I think it's different, in a pre-seed fund like yours or mine. In a sub $20 million fund, I think you want to have more investments than you have in a $100 million fund, because you're wanting to spread it around more. At the same time, you want to have a large enough check size. For example, the reason I started my new fund, my $10 million fund, is that I had done, prior to November of last year, 65 investments, a combination of angel, syndicate, and the prior fund. My check size was variable between $10,000 and $400,000. My track record at that time was 2.8x TVPI, 32% IRR. And you're like, that sounds good. That's pretty good. Probably top, 20%.
Right.
But one of the things I did is I back tested it. I said, on that same selection criteria, what if I had written a standard $250,000 check across the same 65 companies? What would that be? Well, that would have been like an 8.2x TVPI and 112% IRR. What that tells you is that the superior strategy early in pre-seed is a larger standard check size, because you don't know. I mean, if you're varying your check size, the way you do angel investing is you basically are like, how much money do I have in the bank today? That's how much I can write. Now, that's not a successful portfolio allocation strategy, because you're going to have varying returns related to the check size. The superior pre-seed strategy is a standard check size, whatever it is, 50, 100, 250, whatever it is, and write it the same check size across the same selection criteria.
Like a dollar cost averaging, right? If you go back to, Finance 101, you want a dollar cost average into a diversified portfolio of assets, and over time, and then that will yield superior returns. There was a book called Random Walk Down Wall Street. He won the Nobel Prize for this theory. It basically says you can't beat the market. You can just efficiently allocate assets. Do you think that venture investors can beat the market over time?
It depends. I mean, if you say, can venture beat stocks?
Like an individual manager, like a VC partner.
Yes, they can. Venture as an asset class is one of the best performing asset classes relative to bonds or stocks or something like that.
Yeah.
But the only reason it is because of the outliers. And then the question is, can people reliably, generate outliers? If you look at some of the most successful firms, Sequoia, Kleiner Perkins, Khosla Ventures, they can reliably create unicorns and outliers.
But do you feel like they're just grabbing in a dollar cost averaging way? They're kind of spreading that money out in a very predictable way in that asset class, and they just happen to hit outliers?
I think the biggest ones, biggest ones, yes, like Andreessen Horowitz. Andreessen Horowitz is basically shotgun.
An index fund.
An index fund. Tiger is basically a late stage index fund, which didn't turn out too well for them.
No. They got over leveraged. That's a terrible place to be.
But the more traditional venture funds that focus on management development and being very active on the board, people like Benchmark, people like Sequoia, they are not a spread shotgun strategy. They are a sniper strategy.
So like in one of the benchmark funds, how many investments do they make? Because they're pretty much A, right? That's where they kind of target.
They're A. They're Series A, sit on the board, buy 20% of the company, buy more at the B, buy more at the C. I think there are 12.
12 in a fund?
Yeah.
That's crazy. That's an extreme concentration.
High concentration.
Wow.
Yeah.
And they've been right.
And they are,
yeah.
$200-300 million funds. They're not $1 billion funds.
Right.
I actually think these $1 billion funds have, big problems. So there's two ways to outperform in venture. One is reliably. One is to have the benchmark Sequoia strategy, which is high concentration, high conviction, low number of things, very active, operating partners, a process that adds value, and da 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 da. The other way is to, in pre-seed, invest super early. If you look at,
define super early for the audience, because you actually helped me refine the definition of pre-seed and seed. You're one of the first ones to point out the difference to me, because it's sort of transitioned in the last, say, 5 years. So to explain to the audience what
it certainly has. I mean, the number of stages has exploded, and the valuations have changed at each round. I mean, when you look back historically, I was at Ignition when we led the Series A of DocuSign. The Series A of DocuSign in 2003 was 4 on 7. That was a Series A. That is a pre-seed round today.
A big one.
A big one. Maybe more like a seed. But
maybe a seed, but that would be an A 10 years ago.
That's an A 10 years ago. So because the amount of money has exploded, so basically the stages have exploded and so on like that. I mean, the way I define it, I actually put an angel round before the pre-seed. Some VCs don't even talk about the pre-seed and the angel; they just talk about seed. But basically,
angel being like almost like a friends and family angel round.
Friends and family angel, basically before, and I'm only talking about B2B software because that's what I invest in. There may be some other, staging if you're doing hardware or FDA clearance or something like that.
Right.
But for B2B software, basically when people have an idea and they get a little bit of money from their friends or some angels to write an MVP, that's the angel round. That's the friends and family and angel round. Everybody should do that. It's probably
up to 500. Do you think they're synonymous? Angel and friends and family are synonymous?
Basically the same. Angel and friends and family, the same round. It's basically up to $500,000 usually. You use that money to write the MVP, get your first couple customers, hire 1 or 2 people, whatever.
Yep.
The pre-seed is once you have an MVP in the market for 3 or 4 months, you've engaged with customers, you've got some feedback, you've written a better product development roadmap because you've engaged with customers. You're going to raise between 500,000 and $1.5 million, and you're really trying to underwrite to the seed stage valuation companies. And today, seed rounds are happening when companies have around $400,000 or $500,000 of ARR.
Sounds right.
You're starting.
They're almost halfway to an A, not quite the A.
About halfway to an A, right? So the pre-seed starts at 50,000 ARR, and you're getting it to 500,000. Then the seed gets it from 500,000 to 2 million of ARR because the A's aren't happening till 2 million.
Yeah. I mean, it used to be $1 million. Used to be that hurdle. Now it's kind of like 2.
It was $1 million until a year ago. But what's happened as the venture ecosystem has slowed down is that the bar at each level has gone up. The traction level has gone up, which actually is super great for pre-seed VCs like you and me, because we are able, the rounds have gotten bigger at pre-seed because you have to go longer, you have to get farther with that money. Valuations have come down a little bit, so we are buying more of the company at a lower valuation, which is what the whole idea of this venture thing is: buy low, sell high. So.
I just heard my dad in my head: buy low, sell high, Mr. Bry.
Yeah. I mean, that works for stocks too, but in venture, and I mean, we just came off of, probably a 12-year, 13-year bull run in venture capital that ended with a very, significant bubble. A lot of people are having withdrawals from it, but we're going back to more traditional valuation metrics and ranges and stages, which I think is better for longer term company development.
Yeah, I love that. I think you sum it up so eloquently to what that looks like, and it's a little bit of supply and demand, right? I think there's a supply of more and more startups, right? Because software's eating the world, AI is eating software, generating more software. You can talk to your computer now to generate more software. I'm seeing non-technical teams, a couple of product managers building software that is growing super fast. That's creating a gluttony of early stage pre-seed software B2B SaaS companies. And then you, on the other side, on the demand side, you have all this money that's seeking alpha, seeking higher returns, coming down market, generating this opportunity for investors like you and I, and which started 10, 15 years ago with AngelList and syndicates, and is now being further accelerated in this kind of pre-seed market.
Yeah. I mean, the new thing in the last sort of 5 or 7 years is, people organizing. It used to be just the angel funding was you'd have to go to your local angel group and sing for your supper at lunch and hope a couple of rich guys liked you. But now there are smaller funds. There are lots of them. There's hundreds of sub $20 million funds that are all writing $100,000 to $300,000 checks. So you can put together $1 million round with smaller funds, and you don't have to go to angels or bigger rounds than angels could do by themselves.
And you definitely see that transition over the last 10 or 20 years. The rise of the party round is what you're describing. There is no lead at pre-seed, right?
Yeah.
It's just a bunch of 100, 200K checks, sometimes a 250, 500, but for the most part in that 500 to $1 million round territory, you're maximizing the help on your cap table.
And the big multi-stage funds have really gone to the seed or the A. I saw a statistic from Cambridge that says basically 70% of unicorns were funded by a tier one fund at the A. Less than 5% were funded by a tier one fund at the seed. So what really has happened is that the big multi-stage funds have said, we'll let everybody else, angels and pre-seed funds, fund all of the
figure it out,
get them going. Once they get
the signal,
a couple million of ARR, we'll look at the best ones, pick our one we think is going to be the winner, and give them a pile of money and go.
Which is kind of the rise of the scout fund. Tell me about that phenomenon. I mean, that's where like somebody like Jason Calacanis got his start with Sequoia. What's in it for these big VC tier one firms to have these scouts?
Well, I mean, I don't know. I mean, I'm not. I actually think that the plethora of solo VCs and AngelList syndicates and stuff like that have turned out to be an interesting source of scouting for the big funds. I have some fairly formal relationships with a few big funds where I have monthly calls with them and go over deal flow and stuff like that. And in some cases, some of these bigger funds have actually invested in smaller funds to formalize that relationship.
Right.
I think a lot of funds have scout programs, but I actually don't think those scout programs, are, that great. Because those scouts don't provide that much capital. Like a Sequoia scout can write a $25,000 check. That's nothing into a pre-seed round of $1.5 million. I mean, they're more kind of going into angel type rounds for a couple $100,000. But and then the problem with scouts for people like Sequoia is that they write thousands of those checks, and I don't know how much more attention those things get than other companies that come in.
Must be getting information rights or something like that, where they say, "Hey, we're Sequoia. We're going to write this small check, but we want info rights so we can keep tabs and maybe even get a right of first refusal on the A or something like that."
I don't know any CEO who would or should give.
No, I don't think. Yeah,
give
I don't think they would.
a ROFR for a $25K check. But I don't think scout funds, associated with large funds, are really a material impact on the business. I think the real impact for founders and for the venture ecosystem is the solo, 10, 20, $30 million VC fund. Those have made a real impact because they're able to write material checks into material rounds to get material traction, so that the, to an A or a seed type traction level to where the multi-stage funds can actually participate. Angels can't do it. I mean, because the bar has gone up at every level, like it's not. You can't usually get there with a $250,000 friends and family round. You can't get far enough to get the attention and of these big multi-stage funds. And unless you are, third time founder from Stanford GSB, you're not going to get that, $15 million seed round from Sequoia with no product.
Yeah, with just a deck. And you see some of those,
you
right?
See those, but those are definitely outliers. I would actually be super interested, because that's another way that these big funds, rather than writing, $250,000, $500,000 checks like we do, what they'll do is they'll say, oh, well, I like that guy enough, I'm just going to give him $10 million. Right? I'm going to write my standard check size.
Yeah, I believe in this so much. Yeah, I'll just write my $10 million check now, get my 20% ownership, or probably even 30, 40.
Yeah, exactly. Yeah. And so, I've seen Madrona do that. I've seen some funds do that.
And it's almost like too much money too early.
But what I would be interested in seeing is a comparison of that strategy versus the sort of friends and family pre-seed, seed, milestone based, growing up in stages strategy.
Having a little constraint on, just trying to do more with less and being capitally efficient, right?
I frankly don't know which one, has a higher unicorn occurrence or better outcome. I know why the big funds.
I'd love to look at that data, kind of the correlation between round size early, so call it seed, and success.
Yeah, exactly. Like, I frankly don't know which strategy is better.
We'll ask PitchBook.
PitchBook might have that. I actually
have the data on that.
Was going to ask the PitchBook data guy if they could slice it that way. It would be kind of interesting. I don't think it's going to change anything, because like you and I are not going to all of a sudden start writing $10 million checks to Stanford GSB guys. And, Sequoia is not going to stop writing $10 million checks to Stanford GSB guys. So I don't think it changes. It would just be interesting.
What you might call crowding out, right? Crowding out the small investor like us.
I don't think it crowds out. I think we fund different kinds of teams. And frankly, I think that there's a higher amount of, I would believe that our strategy is better, but I don't have any data.
Right. Well, tell us, for the founders listening, and there'll be quite a few, what kind of startups are you looking for, and what are some of the green flags that you see?
So in my new fund, I'm pretty much doing just B2B software. I end up doing a lot of vertical market software for particular, somebody who solves a particular business problem for a particular identified user better than they could with using a general thing. If you're replacing spreadsheets, for example, or, replacing some generalized, duct tape together tool stack with a specific tool stack, I love that. I also like middleware companies that connect in ecosystems of apps. I have 2 companies that are doing that, but B2B software companies. And I am about 60% in the US and about 40% internationally. So
talk about your, and this is another thing I learned from you, is this concept of reducing friction at scale.
Yeah.
What's the genesis of that? How did you come to believe that was a great thing to look for?
Yeah, it goes back to DocuSign. Basically, if you think of what DocuSign was doing, once you sign a document with your finger on your phone, that's so much less friction than printing out a PDF file, signing it, scanning it, faxing it back. It's so much better than the old way of doing it that you never want to use the old way ever again. Right. And that's about reducing friction, right? When I bought Amazon at $6, it was a friction reducing bet. It was like, listen, they're They can ship to your house. They have people who bought this, bought that. I mean, it was an easier way to buy things than getting in your car and driving to Walmart and wading through this giant parking lot and standing in line. I mean, it's all about friction between what somebody wants and how can they get it better. Now that there's friction in business processes, there's friction in consumer things. And what I found is that the companies that were worth a crap load of money were really excellent at reducing friction. I mean, Google was friction reducing, right? Like you could find things. When Google search came out, they were not the biggest search engine. Alta Vista was bigger, Yahoo was bigger. But the minute you did a search on Google, you got better results than you did on Yahoo or Alta Vista, and people switched en masse immediately, and they never went back because it was
Right.
They had less friction between the typing in the search and finding what they wanted, right? So
You know what's interesting about that example? You know, you think about Ron Conway with the shotgun and trying to find outliers, right? And you know, along comes Larry and Sergey. You know, they're the 7th or 8th search engine. We're like, we got something better here. And you know, as an investor, there's some famous examples of folks that, you know, in the valley that turned them down because they're like, there's already tons of search engines. They work pretty good.
Exactly.
Like,
and that's because the people didn't, dig deep enough to understand. I mean, and in that case, it was kind of a deep tech thing. I mean,
it was,
you had to be pretty technical to understand the algorithmic difference between Google's approach and Yahoo's approach.
I wonder how I would have, like, as an investor today, if somebody came along like that, how I would ascertain that this is going to be the next big thing.
Well,
You know, I get a
with
demo.
Google search, it would be super easy. I mean, it was self-evident. Like you have 3 different browsers. You type in something you want to find on Alta Vista, Yahoo, and Google. Google had better results.
Right.
And you know, I don't know how you did it, but like it's better.
It had to be it. I mean, that's how I would do it on a call today.
It
if
was
I'm talking to a founder.
right up front. So, you know, I think you want, as an investor, I look for things that I can understand, you know, the difference, even if I don't understand technologically how they're doing it, you know, I got to see the results of that. You know, so, you just have to dig a little bit deeper, and that's why I'm only investing in software companies, because the other thing that I drill down a lot on founders is that I want the software, some invention, some trick in the software to be what is causing the competitive advantage. And that it was in the case of Google. They had an algorithm that was basically smarter. However they did it, magically they did it. Their software was smarter. I've seen a lot of companies, especially in things like supply chain and logistics, where the software is not in fact providing the advantage. The advantage is, you know, the locations of their warehouses or the number of trucks that they have or some non-software advantage. So as a software investor, I try to parse out, like, is what is creating the reduced friction software or not? And in DocuSign's case, it was software, right? It was only software. And then the other part of my thesis is reducing friction at scale. You look at something like DocuSign, millions of contracts on potentially millions of signatures a day. There's scale there. So you've got a software advantage that reduces friction, and you've got scale. You need both of those things. There's many times where somebody might have a software advantage, and then you may not have scale.
Right.
Right.
I love that. So on the flip side, let's talk about red flags.
Mm-hmm.
So you come across a pitch deck or a founder, you get on a call, you're like, ooh, what are some common red flags?
There's a lot of red flags. I post a lot of it on Twitter.
Yeah, you're very active on Twitter. Yeah.
You know, some super rookie mistakes are things like an exit slide in the pitch deck.
Oof. Yeah, that's oof.
Things like a huge advisor slide in a non-deep tech pitch deck. You know, no financial projections, no why now. The number one missing slide that I usually have is a why now or a thin edge of the wedge. People will spend a lot of time talking about, showing a Gartner slide of how big the market is, but they'll never tell me how they are going to enter the market. Why
what's their wedge?
What's their
what's
wedge?
their distribution wedge?
How do they get into the market and why now? What is different? What is their insight that is? And that's it's missing in probably 70 or 80% of the pitch decks that I see. And to me, it's a flag that either they haven't thought about it. And I always ask the question, but
why now? It's probably one of the most important things besides team. And
it really is because the idea of your product is not unique.
No,
other people have had this idea. This is not unique. What is
definitely something I've learned as an investor is you see the same ideas over and
all,
over again.
all the time.
Yeah.
The only thing that's potentially different is your particular founder market fit to that market and your particular insight into how to enter and get share in that market, which is the part that a lot of people miss. They leave out. They just talk about the size of the problem and they never talk about how they're going to get into the market.
Yep.
Yeah.
So what about mistakes? What are some of the biggest mistakes you've made as an investor over, your 25-year career doing it?
Oh, lots and lots of mistakes. I'm working on a post about that too. Some recent ones, I signed and wired to an investment that was where I was co-investing in pro rata for a new lead. And I wired before the lead wired, and then the lead never wired.
Oh.
And so I was stuck in a rat trap and couldn't get out. So that's a mistake. There's
I got one too. We'll just go back and we'll ping pong it. I had a founder who sent me some really nice looking slides with some up and to the right numbers, but they failed to tell me that they were cumulative numbers, and it wasn't clear from the slide that they were. And so they're just basically like, look at this revenue; it's going up and to the right. I'm like, this is great.
Sure.
You're almost doubling revenue every month, and I'm getting ready to wire. I'm deep down in my due diligence, digging into the P&L, and I'm like, wait, you've been flat for 6-7 months here, and I was just about to wire. Like I was getting ready. He's like, if the round's closing, gotta hurry. I'm like, I gotta look at your monthly P&L, and right before I wired, and it really made him upset. But I guess it's not a mistake, but it was a mistake to go that far.
That wasn't a mistake of yours. It was a mistake to not ask. Yeah, I have some more in that category, like where, I didn't make a mistake, but it was a founder flag that, ended up having to be a conversation. The other one that some founders do is conflating setup revenue or one-time revenue with ARR and MRR. I've seen that multiple.
They call it ARR, but it's not actually recurring.
It's not recurring, right? I've seen marketplaces with transaction revenue calling it ARR, and I'm like, you're not ARR. I have never made the mistake of investing on reliance of those numbers, but I've always pointed that out and seen, CEOs try usually, the positive case is that they're new CEOs and they just don't understand and they need to get better accounting. The other side is, they could be trying to lie. As far as mistakes, I wouldn't call it a mistake, but I have had 3 companies fail because of fraud. And it's hard to say that it was a mistake because, when I did my diligence and I wrote the check, I was relying on their statements. And in the future, I found out that their statements were false. You can't always find out those things beforehand. But like in one case, I asked for financial statements. They provided me with made up fraudulent financial statements from a bank.
I can't believe it. That's amazing.
And it's really hard for me to.
That's securities fraud. I mean,
It is securities fraud.
Yeah.
We're in a lawsuit, but was it a mistake for me to invest? Yes. Was it hard for me to know that they were showing me doctor documents? Yes.
Right. Because I mean, you have to kind of almost take what the founders say at face value. I mean, you can do background checks.
You can do diligence, but there's only a certain amount of confirmatory diligence you can do. The second fraud case was, they were talking about, it was a consumer sports betting app, and they were talking about daily active users and downloads and stuff like that. And I looked at all the numbers and I said, those look great, like you did. And I confirmed them with Google Analytics dashboard, and it looks fine. But then after we invested, they started inflating their numbers to get the next round done. And they got the next round done at like a 3x markup. But when that guy didn't believe the numbers, and he brought a third-party auditing firm in and came in, and turns out that they had inflated their numbers.
Oh, wow.
So that was unfortunate.
The pressure's real, right? Some people crack under the pressure and try to take shortcuts.
They try to take shortcuts, and they try to fake it. There's a line between faking it till you make it and lying. Faking it till you make it is okay. Lying is not okay.
Yeah. How do you feel about solo founders?
You see a lot of them in pre-seed. I tend to not like it because you need basically 3 or 4 core competencies to have a real company. You got to have somebody who can raise money. You got to have somebody who can build a product. You got to have somebody who can attract customers, and you got to have somebody who can run operations. That sometimes
it's hard to get
is
all 4
the
of
same
those in
person.
one person. Yeah, that's very tough.
But it's very hard to have one person do 4 jobs.
Yeah.
It's more common to see 2 people doing 4 jobs.
Yeah.
Or 3 people doing 4 jobs, but you have 4 distinct jobs. Now, a lot of people just skip on the operations thing in the beginning, but that's fine. I can shortcut on that. But you cannot shortcut on raising money, building the product, and selling customers.
Yeah.
Those 3 things. And it's typically not always the same person.
Yeah, makes sense. What about coming into the round? So do you like, what part of the round do you like to come into? Early,
I
mid,
only
late?
participate in fully funded rounds that provide 18 to 24 months of runway in the pre-seed. So I will not do hand-to-mouth rounds. One of the flags getting back to the flag thing, is a company saying, I'm raising $1.5 million. It's like, oh, great. How much have you raised? 800,000. How much have you spent? 700,000.
Ouch.
So you're not raising $1.5 million. You're raising 800,000 from here. So the round is the money from when I wire. How much runway do you have? And these forever financing rounds that raise and spend. This is not how you. I do not participate in those kind of rounds. I don't do hand to mouth rounds. I don't have to be the last person in, but I have to be in a round which is completely funded, with a syndicate of investors.
Call it more than 50%.
To achieve a specific set of objectives. The number one risk in pre-seed is underfunding the objectives.
Yeah.
And I have done that before. That's another mistake I have done. I wrote a $150,000 check into what I thought was a $500,000 round that ended up becoming a $250,000 round. And now all of a sudden you're in a company with half the money to meet its objectives.
That's another good lesson right there. What is the runway after iWire?
What is the runway after iWire?
Yeah. Not after the round's complete, but after iWire. What's the cash in the bank and what's your burn? Talk about capital efficiency. This is something I've been getting much more interested in lately. What's a good burn multiple for you in the pre-seed? What are you kind of looking for? They raised the $250K. Now they're raising the pre-seed. What do you like to see?
I mean, pre-seed, if you're only getting, 30, 40,000 of ARR when you come in, your burn multiple is going to be infinite. It's going to suck. The burn
It's
multiple
50K
really
divided by 250K. So it's not, it's like 0.2, something like that. You burn 250K basically to get 50K of ARR. Would that be good enough?
No, that's not 0.2. That's 5.
Oh, I thought it was the other way around.
No,
Denominator. Okay.
it's the other way around. So like at the Series A, one of the companies I invested in,
you're multiplying the burn. So like you burned, you got okay.
You wanna burn less than the ARR you added. So when this company that I was in called Vega Cloud did their Series A, their burn multiple was 0.6. They had burnt 3 million and added 5 million of ARR.
That's a good burn multiple.
That was 0.6. So
you got escape velocity here.
If it's under 1, you're positive. It's very rarely going to be under 1 in pre-seed. It's most like, I would like to see it under 10. Okay?
Yeah.
In pre-seed. As you get closer to seed, it should be in the 2 to 3 range. And as it gets to the A, it better be fucking 1 or less than 1.
Has to be less than 1 at that point.
Has to be less than 1 at the A.
Yeah. Makes sense. So let's switch gears and talk about kind of Martin outside of venture. What are your personal passions? What are you working on? What are you excited about?
Well, I just got back from France and I rode up Ventoux on my bicycle. So I like to ride my bike outside a bunch. I'm kind of one of those crazy workout guys. I was the CEO of Upgrade Labs, which is a biohacking facility run by Dave Asprey for a couple of years. And so I have a whole bunch of crazy biohacking shit. I have a $600,000.
That's a whole other conversation that I'd love to get into.
I have what's
your daily supplement regimen look like?
I have a bunch of supplements. I'm not that crazy on supplements, but I take, 5 or 6 a day. The most important ones are NMN, which increases your NAD, NAC, and some. I take some in clomiphene to.
I haven't heard of that.
It's a natural testosterone increaser.
Oh, okay.
Yeah, it's a derivative, it's a citrate version of Clomid. But it's much better for you than taking testosterone replacement therapy. And hormones are...
My father-in-law, who's really into this, he's a retired medical doctor. He's in his 70s, very much into longevity. Just published a book, actually. We'll have him on the podcast at some point. And he was literally taking injections of testosterone and kind of measuring it and kind of keeping his testosterone at like a healthy 30-year-old male level.
That's certainly one way to do it, and that's the cheater fast way to do it. The problem with taking injections of testosterone is that you're getting exogenous testosterone, basically from outside the body. What this enclomiphene does is it kicks your gonads in the gonads, basically, and makes you make more testosterone yourself. The problem with taking exogenous testosterone is that your body says, oh, you got a lot of testosterone, I'll stop making it. So it's a great fucking business model for the companies because you create an addict whose body stops making its own thing and they can never get off your fucking thing. It works, but you're taking injections for the rest of your life.
Wow, that's intense.
So that's
what about like
unfortunate?
Yeah,
I think.
Yeah.
I mean, if you can do it any other way, I would prefer to do that. But I mean, I'm sure your dad. Basically, anybody over 50 is going to feel, a male is going to feel much better with more testosterone. And there are artificial ways to do it. There are natural ways to do it, but you should pay attention to it.
Yeah.
Yeah.
That's interesting. I didn't know you're into the longevity stuff.
I'm into longevity, but the more important thing that I'm into is regenerative medicine. And that's the way I approach longevity. I mean, kind of like your dad was talking about. I mean, the point is you want to have the body, because the basically all cause mortality profile of a 30-year-old is 0. Like 30-year-olds don't die. So what you would like to be, not from cancer and coronary heart disease and all this shit, right? Old people do it, but it's because their bodies have degraded. So if you can prove metabolically that your body is functioning like a 30-year-old, testosterone level, telomere length, blood sugar, metabolic function, all these other things, then, you have a higher, a lower chance of all of the all-cause mortalities that old people do. I mean, old people have all-cause mortalities rates very high because their bodies are just running out of steam. And if you can prove that your body's not running out of steam, that's a better longevity strategy. So that leads you to a lot of regenerative medicine stuff. And testosterone is basically a regenerative medicine thing, right? It's like, I want the testosterone that I had when I was 30.
Right.
And there's a way to do it now. You don't have to accept low testosterone.
Do you need to get like blood work from your doctor to kind of measure the testosterone?
Yeah. I mean, you can test that at home now with a blood test for like $80. I mean, it's super easy. There's all these at-home stuff. So I do a lot of stem cells and regenerative medicine things, because that's my whole strategy for longevity, is to just try to keep my body young and get it healing faster. So like 2 years ago, I was riding my mountain bike in Bentonville, Arkansas, and I hit a tree at 25 miles an hour. Oof. And I broke my shoulder. And, when you're older, it's a lot harder to come back from injuries than when you're younger. And I went to the doctor, and they're like, oh, you just have to sit and watch television for 6 months and it'll be fine. And I'm like, isn't there anything regenerative that I can do? And they're like, nothing that's FDA approved, sir. And I'm like, oh, fuck you and your FDA. So I went and did a bunch of biohacking shit. I did hyperbaric oxygen therapy. I did pulse electromagnetic fields. I did stem cells. I did BPC 157 injections.
Did you have to go down to Mexico for the stem cells?
Yes.
Or? Nice.
So, I mean, I spent like $50,000. But I don't fucking care. And in 4 weeks, my shoulder was completely healed. The crack was gone.
Yeah.
I go back to the doctor. He goes, it's a miracle. I go, it's not a miracle. I just spent $50,000 on non-FDA approved shit that you don't know about.
Yeah.
You can't do it.
Yeah.
Like
that's the thing with our medical system, right? Like by the time they discover something and it goes through all 3 phases, it's 10, 15 years later.
It's 10, 15 years later. There's also a giant, industry that doesn't want that stuff. I mean, the pharmaceutical industry is doing everything they can right now to cock block stem cells, because stem cells are, like a miracle cure for everything. You don't need pharmaceuticals, because the current medical system is basically do what the fuck you want, and if you break, we'll try to fix you with some drugs and surgery.
Yeah, well, we'll give you a pill that you have to take every day for the rest of your life.
For the rest of your life, and we'll make a whole bunch of money, and you're going to live this very low quality life till the end of your life. You're going to die. And stem cells and other things are like, no, we're going to like make you young again. We're going to like fix you.
We're going to use your cells to regenerate your cells. And
naturally.
I was thinking about getting this I still play basketball in my mid 40s, and my knees, are starting to just not be as strong as they were, right? And been thinking about flying down to Mexico to get the stem cell injections into my knee.
They are pretty much a miracle cure. And the traditional medical system would say, no, you can't do that. You have to get artificial knees. You have to get surgery. You have to get cartilage replacement, because they know how to make money on that. And you know what? If you got the injections from the stem cells, they wouldn't sell you their surgery. So they're not going to tell you that there's an option.
It's a just like in software, when a new technology comes out, it radically changes the playing field.
And they are not interested in it.
Yeah, they're like the telecommunications companies trying to block, software that allows you to make calls over Wi-Fi.
Exactly. Yeah, they tried to do that because they, monopolies.
Well, why don't we switch to a rapid fire round? What's a transformative read that given all your interests, that really shaped your investment philosophy and life approach?
Thinking in Bets by Annie Duke. A pro poker player tells you how to make decisions better. I give it to all my founders.
Thinking in Bets. I like that.
Thinking in Bets by Annie Duke.
Writing that down. I haven't heard of that one.
I have a pre-seed founder reading list on my blog.
I gotta go check that out.
Go check
Pre-seed.
it out.
I'll put it in the
Put it in the show notes.
Yeah. Pre-seed founder reading list. With so many things going on, what's your go-to productivity hack that keeps you on track?
Time blocks. Work for 25-minute sprints, take a 5-minute break.
I love it. So you got to do a task, you just put it on the calendar.
Put it on the calendar. I use a calendar thing called Motion, which is a AI calendar bot, and you put all your tasks in priority order and it autofills your calendar for you. And if you don't do something, it reschedules it.
Huh.
And refills your future things. So it keeps the highest priority things, keeps putting them in front of you until you get them done.
Motion.
Amazing. Motion.
Interesting. Yeah, I haven't heard of that one either. How many founders are you meeting with per day?
I get about 300 pitches a month. I look at about 70 decks. I take about 30 meetings.
Okay.
In a month.
You're very disciplined with your meetings then. It's you're only meeting with the best ones.
I'm only meeting with the best ones, and I only do meetings on Monday and Wednesday afternoons. That's another productivity hack, is to use time blocks. So like I only meet with founders Monday and Wednesday afternoons between 1 and 5.
Why is that? Why not just kind of willy-nilly throw it wherever it fits?
Why do you think?
I would think that it's context switching, right?
Too much context switching.
Yeah.
Plus, I want to allow time blocks for deep work or for portfolio support, for LP fundraising, for whatever it is. And if you allow your calendar to have any meeting, any time of the day, you're going to context switch and everything. And it's like, listen, no, like I have 8 hours a week to meet new CEOs. 4 hours on Monday, 4 hours on Wednesday. Those are the only times I can talk to you. Yes, I'm booked out, but I am not going to make a special thing on Friday, because you would then jump, a CEO meeting in the middle of writing a blog post that I also want to do.
Right. I love that. Yeah, that's very interesting. Yeah, I might try that.
I have specific times of the day. I have, a workout time block, which is non-negotiable. I have different time blocks, and I keep them all in the same type of.
I do the workout time block. I block out 2 hours for lunch, and that's my workout.
There you go.
Eat lunch, and then I block off time at the end of the day to just have free time to get stuff done.
Yeah.
Tell me about your dream summit. If you could have a dinner with 3 figures in the realms of technology, venture capital, and just generally, who would they be?
Dream dinner. I have no idea. I'm never a good answer. I do not. I'm not the kind of guy who's had a lot of mentors or who wants to, is a star fucker. So I don't have a good answer for any of that.
I love that phrase, star fucker. I'll have to mark this episode explicit.
Yes, I do not have a good answer for that.
I'm similar. I think there are people I admire that I'd love to have dinner with. But you strike me as somebody you have high self-efficacy.
I mean, I always try to be the dumbest person in the room. I was at a conference one time. I was sitting at a table with Elon Musk. It was great because he was obviously the smartest person at the table, but everybody was getting a benefit from it. And people weren't sitting there going, "Oh, Elon, you're the greatest thing." It was an interesting conversation, and everybody was getting better for it because of it.
Yeah.
So I like being in rooms full of smart people, hopefully smarter than me, or especially smart. And that's why I'm a venture capitalist, is that, I want to meet founders that are incredibly passionate and knowledgeable about something I know very little about, but they can help me get smarter about something, and I can give them a perspective that they may not have thought about. But it's that combination of smart people that makes magic.
Yeah, I love that. It's why I enjoy the job so much as well, as you get to meet the coolest people building the coolest stuff, and they tend to be smarter than you.
Mm-hmm. Mm-hmm.
What's a hidden skill or talent that you've acquired that people might be surprised to learn about?
I can hold my breath for a really long time.
Oh, you do the Wim Hof thing? And
Yes.
oh, interesting. You do the cold plunge with
I
the
do
Wim
cold
Hof.
plunges. Yeah.
Yeah, I love that.
Cold plunges and holding my breath.
That's amazing. Yeah, we do that too as a family. We have the pool outside, and here in Northern California, it gets quite cold here in the Sierra foothills and down to about 45 degrees. And now we'll go do the cold plunge. Starting to happen now. Podcast Gold. Is there another podcast that you'd recommend listeners to check out?
The only one I listen to regularly is kind of mundane because everybody listens to it. I think the All In podcast is probably the best podcast on the internet right now.
Yeah, 100%.
And mostly it's just because they talk about investments and all that stuff, but you have a rational conversation between two diametrically opposed political views happening on a regular basis where they're actually seeking truth and not just yelling at each other. This is incredibly rare in American discourse.
Yeah. And that's why it's so popular. And I've seen, I've been a long time show listener, and it's really interesting to watch Jay Cal like kind of shift to the center a little bit over the last like couple of years.
Yeah.
He started off pretty far left.
He was a total libtard in the beginning.
Complete libtard. Let's talk about time travel. You could jump back or jump forward, see a missed opportunity, go back and get that missed opportunity, or jump forward to see how one of your current investments pans out. What would that be?
I would go back to 2000 and buy $1 million of Amazon at $6 a share.
That's really, what would that multiple be now? A ton.
I mean, it's split like 7 times since then. I mean,
so that's 1,000x.
It'd be 1,000x, yeah.
Be $1 billion right now.
Be about $1 billion right now.
Crazy. You have a thrill in solving hard problems. Is there a motto or principle that guides your decision making?
Focus on what's in your control and ignore what's not in your control.
Love it.
And make the best decision you can with the information you have at the time. You have to just put one foot in front of the other and keep going. People who sit around and wish for better external circumstances, wish for better talents, better smarts, more money, whatever, you're not helping anything. Make the best decision you can and move on with what's under your control, and move the fuck on.
Yeah. Turns out most of success is just hard work.
Yeah.
It's just getting down to business.
Hard work and showing up.
And what's the famous quote? 85% of success is just showing up. Who said that?
Yeah. Somebody said that.
Yeah, I forget. Anyway, this has been a great conversation. I know we went over. Thank you so much for
no problem
coming on the pod. This is a very enlightening conversation.
All right. Thanks, Brian.
Thank you so much.
Talk to you later.